You're underweight bonds. That must be a little bit painful with what we're seeing in yields at the moment. So how exactly are you putting on that underweight bonds trade?
Yeah, I mean, it feels like the bond market is still very reactive to risk, and treasuries, they have a lot of buffer, you could say, and they have more potential to move down. But I think compared to history, I think the bond market doesn't react as it used to in risk off. I mean, just to give you an example, in the global financial crisis, the market obviously fell more than 50%, and you had treasuries rally 25%. If you look at last year's 20% decline in the equity market, the treasuries rallied like 3 to 4%. So you can see the beta of the bond market to equities on the way down is a third, if not a fourth. So you have to ask yourself, how much protection in risk off are you getting relative to, how much they could cost you if there's a resolution or if you're dealing with an inflation shock. And maybe the market is a bit complacent as well with regards to how much the Fed will actually cut, because the market is already pricing more than 2 cuts in the next 2 years, close to 3. And we think that's quite unlikely unless you get something really sinister, really bad happen. And you have to consider the inflation impact from the tariffs as well. There's not only a growth impact. So I personally think, like, if you have a curve in the US in particular, which is so flat, you can also be in cash. And you might have seen it in my allocation. We're in cash, and cash is also something that can protect you. If you look in the US in particular, if you're in short duration, low risk credit, you can easily achieve 3%. It won't be necessarily as reactive, but it doesn't necessarily have that type of risk attached to it as bonds might do.
It's interesting that you make that point with that flood of money come into very short-dated ETFs on 2-year paper, one of the biggest flush moves yesterday this year. Christian, can we pick up on the inflation thing that you've just mentioned? You said, look, we could get a shock. And you're right, maybe the market is overstretching at 3 hikes. I put together the break-evens very quickly, just as a hook for us to talk about the inflation risk in the US. You have been long inflation risk, but have a look at the break-evens. What is your perspective now? Is this where one of the risks could hide in the US story?
No, without doubt, if you look at the drivers of risk appetite and the stabilization in markets, monetary policy being really dovish has been critical to stabilize markets. So if you now introduce inflation risk into the equation, the dovish Fed narrative could start to become less strong. And I think that is a key risk. There's a variety of things that drive break-even inflation. I think if you look at the most important driver is actually the oil price. And you were speaking about that earlier with regards to Middle East tensions. And I think that definitely has the potential to push up break-evens a bit further. Having said that, the Fed doesn't really care much about the oil price-related effects on inflation. They mainly care on core inflation. And with regards to core inflation, the tariffs, they are a big risk. We know that if you look at the last round of tariffs, the 25% on the next 300 billion, they have the potential to be much more inflationary than the previous few rounds. And that's because they include a lot of consumer goods. And the problem you're facing is, at the face of it, the impact you actually look at is not that large.